What's going on, everyone? Sal here with a brief update about the market, where we are, where we possibly could be going. I really wanted to share some of my thoughts with you briefly here. Now, when we look at the chart, I'm going to be using the SPY Exchange Traded Fund, and I want to talk about, using an ETF as an indicator. It's a really interesting strategy that I have seen people use over the years, but only recently started taking more seriously. If you haven't been following the macroeconomic news that's been going on, the Federal Reserve recently came out the other day and basically said they're going to continue what I've talked about a lot on my show, which is QE forever. Okay, low interest rates, easy, cheap money, because we are in a situation where the bankers run the world, right? So the responsible thing to do is, when low unemployment is the game, there's a significant amount of growth in the economy, you are supposed to raise interest rates to cool things down a little bit. Well, we have decided, and not necessarily me and you, to continue to pursue a basically 0% interest rate environment for the markets. And now what we're seeing is that has come to not be as effective as it was for many, many years prior. So we're seeing slowing growth happening across the world. And I want to show you guys some evidence of that here with this chart. Brief moment for me here. And I'm going to have that up on the screen right now. So as we see here, using 10-year bond yields, as we see here, falling across the world, Switzerland, Germany, Japan, UK, we're starting to see people run into these, securities that provide them a little bit more safety and less risk, right? So when bond yields decrease, that means they're finding people buying, into these safer securities, or safer financial instruments, rather. A bond is a financial instrument. So they don't need to pay you more because they're attracting all the capital they need. So bond yields go down. And that's why we've been having a conversation across the market about inverted yields, right? An inverted yield. And I'll have a really good video in the description where you'll be able to watch and get an understanding about what people are so afraid of when we talk about an inverted yield. So when we look back on the chart here, here's the SPY, and here's, of course, the recent resistance that we've been developing. I do have, I want to pronounce it, I hope, I just call them ashy charts, but Hankin Ashy. I know I'm probably really messing up the word, but I've started to use these charts a lot more because they've really been very helpful in determining what could be a change in trend. I think they're the best charts for that. I'll have another video up later about how to use these charts appropriately. But going back to what I was talking about, when we talk about now inverted yield and how we talk about how people are moving to these safer securities, how do we measure, how do we really follow that? How do we get in front of what could be the development of a recession, right? How do we get, and I think there's a even better instrument, because I know there's some bond ETFs out there, but there's an even better instrument to follow, just because, in my opinion, we have so many weak companies out there. We have so many companies that are running on virtually no profits. We have so many companies that are highly leveraged, right? That have taken the opportunity to use the environment that we've been in the last 10 years to stay in business. One way they've been able to do that is by using what are called leveraged loans. And leveraged loans are basically personal business loans that are given to individuals or companies that have very poor revenue or bad credit. And there is a financial instrument, what's prepped. There's an ETF for that. Like people say there's an app for that. There's an ETF for that. And it's called BKLN. All right, BKLN. And what you want to do is you want to take BKLN and I have my trusty trading view chart and put it on the screen, right? Let's just go ahead and slap it on the overlay. And this is where we are right now. And if you follow BKLN, right, and you see how when people have faith that they're going to be paid back on these risky investments, the market runs, right? BKLN rises, and also the market rises overall. When people have faith or have lack of faith that the companies that are borrowing these leveraged loans are going to be able to pay them back, the market sells off and sells off quite aggressively. And here we are when we overlay the SPY with BKLN, we see here there's a huge divergence that's happened here, right? So we've already seen that now value of leveraged loans, or at least the faith in these leveraged loans, is decreasing. And now we're starting to see the SPY catch up with how other people are starting to feel about the weakness developing in these companies and their doubt about their ability to pay those lenders back. And if we can use another ETF like IWM, for example, and we get an even better, see what I'm saying? We get an even better look at how following BKLN and then how IWM responds accordingly. Why? Because IWM is full of very poorly financially managed companies that have horrible books, companies that are over leveraged, companies that have huge amounts of debt. But again, we're living in an environment where they can survive because money is cheap. But again, things just aren't working out. We're starting to see the markets globally slow down, as I just showed you, people moving to safer investments. And now even the cheap money isn't working. And now we're starting to also have the conversation about possibly having the Europeans, basically create money out of thin air, right? Create more money out of thin air, more QE in Europe to hopefully spike up the market, but it may not work. Check out Peter Schiff's podcast for a lot of his thoughts about how he believes the next recession is going to be worse than the last. And I have been able to find data proving that our leveraged loans balances today are even higher than they were in 2009. So he might be right about that. I wanted to put this information out to you. I know I've given you a lot of information in a very short period of time. It's your boy Sal. I've got so much to give to you. I've learned so much over the taking this break, taking the time to really learn more about the market and how it works. A lot of people have already been using this, but there are a lot of people who don't know about this, and you really need to know about how to really take a look at what some of these other ETFs and how they're used to be able to somewhat predict where the market could be going next. All right. It's your boy Sal. I'm out of here. Next video will be up soon. Take care.